Hello, welcome to Module 10, and our topic today is bank holding companies. So we have talked about bank holding companies sort of off and on, and bank holding companies are the companies that own banks. They hold banks. And there are two types, which we'll discuss today, and which you heard about in the reading, the traditional bank holding company and the newer financial holding company. But to just give you a visual picture, which I think helps, in a bank holding company structure, you have the parent company, that's the bank holding company. It can own multiple banks. The banks can own subsidiaries, and there can also be side-by-side affiliates, non-banks. But what is key in this structure is that there is a bank. So there can be, like I said, one or many. And over time, it has varied. It used to be more common for bank holding companies to own multiple banks, but now we're seeing consolidation. So we have typically now the bank holding company, one bank, and many non-bank affiliates. So we talked about the Bank Holding Company Act that was enacted in 1956. It was enacted in response to the concern of the mixing of banking and commerce. We had companies that were engaged in retailing and manufacturing, owning banks. There's a concern with economic power being concentrated, again, when you combine these different activities. And so the Bank Holding Company was enacted. And it is under the Federal Reserve Board. And it applies to any company which has control over a bank. And as we'll see in all of banking law, but particularly in the Bank Holding Company Act, it's a very definition-driven statute. A bank holding company is subject to the Bank Holding Company Act if it is a company which has control over a bank. A company is broadly defined to include almost any kind of organization, except an individual. An individual is not a company, but a LLC, even a large enough partnership. It basically is an all-encompassing definition. Control is also broadly defined. It includes any company which owns or controls 25% or more of a bank. And even below the 25%, the FRB can determine that there is control. And it can be control of the voting stock. It can be control of the board of election, the board of directors, the election of the board of directors. Again, it's very broad. And so what is interesting is that the tricky definition is the word bank. And that was one of the cases that we read for today. And once a company becomes a bank holding company, which means it has acquired a bank, it is under the Federal Reserve Board and its activities are restricted, just like we've seen in regard to the bank itself. But because the word bank is kind of the key definition and the one that has been played with the most since 1956, we did read a case about this. And it goes back to 1986. And what was happening was companies were not wanting to be under the Bank Holding Company Act. And at that time, a bank was defined as an institution that accepts deposits that the depositor has a right to withdraw on demand and engages in the business of making commercial loans. And so what that did was pick up the larger banks, which made commercial loans and also offered checking accounts, transaction accounts. There were smaller institutions that were oftentimes just for savings and didn't make any commercial loans. And so this definition was designed just to pick up the larger banks. But what happened was the banks, through their attorneys, decided that, hey, why don't we offer an account that's like a checking account, but in the contract, it says you have to give the bank 7 days notice. And that's called a NOW account. And it will work like a checking account, but it won't meet this definition. And instead of making these commercial loans, let's let someone else make them and we'll just buy them. And so it was becoming common for banks to structure themselves and their activities in a way to avoid the Bank Holding Company Act. And in the area of banking, there is a term called a non-bank bank. And a non-bank bank is a bank that doesn't meet the definition of a bank under the Bank Holding Company Act. And if the bank does not meet the definition of bank under the Bank Holding Company Act, the entire holding company avoids the bank holding company regulation. And, it can make life much easier. But needless to say, the Federal Reserve Board was aware of what was going on, and so they adopted a regulation. And it was called Regulation Y. And so what it said was that a bank includes an institution that accepts deposits that, as a practical matter, are payable on demand, such as a NOW account, and engaging in the business of making commercial loans includes purchasing commercial loans. Now, I don't know how much you know about the Administrative Procedures Act, but as an administrative agency, and as we've sort of touched upon, they are permitted to adopt regulations that sort of fill in the gaps and give the detail. But the question is that what this regulation is doing? Well, needless to say, some of the bank holding companies, or the holding companies who didn't want to be bank holding companies, didn't believe so. And so they brought this case that we read. And they challenged this regulation, and they said that it was not within the regulator's authority because they were going beyond the statute. They were not just clarifying areas of ambiguity or filling out the detail. They were basically writing the law. And this was at a period when the courts were using Chevron deference, so it just had to be reasonable. And as we saw in the court's decision, the court acknowledged that the banks were trying to avoid the statute and that the Federal Reserve Board was probably justified on a kind of a theoretical basis to make this regulation, which kind of got at the intent of Congress. But ultimately, the court said, this is really for Congress. If Congress wrote the statute too narrowly, then Congress needs to fix the statute. And so you will notice throughout the semester, as we look at some of these cases, sometimes the courts are, they're more open to regulatory interpretations that achieve congressional goals. And sometimes they throw it back to Congress. And that's what this court did. And this time, Congress took them up on it. And they did amend the definition. And so the definition we have today takes a different approach. What the definition does is it basically says a bank is any insured bank, which is basically and absolutely every single bank. So it keeps the old part as Part B, but it starts out with a definition that brings in every single institution. Well, that, of course, was never anybody's goal. So what the definition now does is then it excludes certain types of companies or certain types of banks, actually. One of the types is the credit union, although it's not really a bank anyway, but it does expressly exclude credit unions. It also excludes credit card banks. Now, that was a type of bank that was quite popular at one time because it was a national bank that really just issued credit cards. And under this definition, the definitions are actually quite long and complicated. This is just sort of a shorthand. The bank can't accept any deposits smaller than $100,000, and those deposits can only be accepted at a single office. And it's quite detailed. It used to be very popular. A lot of the retail companies opened credit card banks, and they could do that because they weren't a bank. They were a non-bank bank under the Bank Holding Company Act. For whatever reason, not nearly as popular as it was, basically because there was a time when retailers would each have their own banks and the credit cards would be issued by the bank under the same company. And now all the retailers go to particular banks. So certain banks, all they do is issue credit cards for retailers. But at one time it was popular. The remaining popular type of non-bank bank is the industrial loan company. You might remember that we've talked about that. It's a type of state chartered bank. And when this was adopted, which was 1987, what it says in the definition of an industrial loan company is that it has to be an industrial loan company that is chartered under the laws of a state that existed on March 5th of 1987. So this is this grandfather concept. So they grandfather in existing industrial loan companies, and they also grandfather in the state laws. So new states cannot have industrial loan companies that meet this non-bank exception. So that has to be an existing, and there are other restrictions on what they do and who owns them. And this was a very popular way and continues to be, or to some extent, although it's also controversial, because it is a way to own a commercial business, a manufacturer, a retailer, and a bank, all under the same parent company. And so just to give you a sense, GE Capital used to have both an ILC and a federal savings bank, which was also another exception. They closed down their ILC and they turned their federal savings bank into a national bank, but they had them for quite some time. BMW continues to have an industrial loan company, which they use to offer all kinds of credit, in part to people trying to purchase BMWs. And so BMW could never own a bank under the Bank Holding Company Act, but they can own an ILC. American Express also had an industrial loan company and a federal savings bank, which they merged and converted to a national bank. So in 1987, there were 58 ILCs, so not a lot. And in 2020, we were down to 23. Between 2017 and 2021, there were 12 applications. It started to get popular again. Again, because it is a way for a more commercial firm to get into banking, but that also makes it controversial. So there's different ways of looking at it. Some think that it's a way around the rules and it's unfair, but others believe that the existence of some of these, such as BMW's ILC, and the lack of problems shows that really some of our concerns are misplaced, and there's really nothing wrong with commercial firms owning banks. But it was and continues to be very controversial. Walmart, I had mentioned, and I had you read a note on for one of the other modules. Walmart decided that it wanted to get into banking, and it sought to acquire an existing ILC in California, and California immediately amended their laws to prohibit that type of a purchase. Walmart then was able to acquire an ILC in Utah, because typically, because of these grandfather provisions, you have to get an ILC that's already in existence. So they were able to obtain the ILC in Utah. Utah is very friendly to banking and anything related to banking, but they then sought FDIC insurance. And the FDIC decided that they needed to hold hearings across the country. And they also issued a moratorium on insurance for ILCs. Now, this didn't really appear to be a coincidence. It seemed to coincide exactly with Walmart's application. And finally, Walmart was like, yeah, forget it. And they withdrew their application. What's kind of interesting about that is that Walmart now has, I don't know if they call it a banking center, I think they call it a money center. So instead of offering banking services, they offer things like prepaid cards and check cashing and wire transfer. They offer a lot of services that are related to banking, but not through a bank. And in fact, the services they offer tend to be more expensive than if consumers were getting them from banks. So it's not clear whether it was good or bad for consumers that Walmart was essentially beaten out of the banking industry, but whatever, they seem to be doing just fine. So because of all of this concern and the Walmart situation, in the Dodd-Frank Act in 2010, there was a moratorium on granting FDIC insurance to any type of company or any type of bank, rather, that would fall outside the Bank Holding Company Act, such as an industrial bank or a credit card bank. Now, that only existed for 3 years, so that would have taken you to 2013. But in fact, there were no approvals for any type of FDIC bank insurance application until 2020. So it really worked as much more of sort of a 12-year moratorium. But the FDIC did show some willingness to grant FDIC insurance. If you're thinking back about the timing, you may remember there was some different administration that would be in charge of appointing the executives at the FDIC, which may explain why these applications were approved. But anyway, there are a number of ways for a bank to be outside of the Bank Holding Company Act, which allows a company to engage in a lot more activities. And so just something to think about if you ever see kind of a retailer offering a bank. And if you have any cards, I suggest that you look at them, and you will likely, credit cards that is, see that the retailer's name is on the front and there's actually a different bank on the back that's issuing it. And they're just a very traditional bank. But if you go that route of actually becoming or staying a bank, and you're a company and you're buying just a real traditional bank, you must obtain the prior approval of the Board of Governors of the Federal Reserve. And it's really, if a company buys their first bank, that makes them a bank holding company, they have to get approval. If they buy a new bank, they have to seek approval. If they buy another company that is going to be a bank or a subsidiary, they have to basically, any kind of activity, merging with another bank holding company or another bank, any type of activity requires Federal Reserve Board approval. So you can see that it's somewhat burdensome, but it also gives oversight. So that's always a balance, how much oversight versus the burden on the banks and their holding companies. Probably even more significant is the restrictions on activities. So once one is a bank holding company, they cannot acquire any company or own any company that is not either a bank or a company that engages in activities that are so closely related to banking as to be a proper incident thereto. And what we see here is that determination of whether or not the activity is a proper incident thereto is grandfathered or closed down as of November 12th, 1999. That happens to be the enactment of the Gramm-Leach-Bliley Act in the new kind of holding company. So all new activity has to be in the new holding companies. So what this means is that if a company is a bank holding company and they own a bank, all their other companies under that parent company can only engage in activities that are related to banking. If a company buys their first bank and is just becoming a bank holding company, they have 2 years to get rid of any company that isn't engaging in activities that are closely related to banking, and they can request 3 years. But basically, at the end of the day, after the 2 to 5 years, all the companies under a bank holding company must be engaged in activities that are closely related to banking. So to give you an idea of what that means, it, of course, is extending credit and servicing loans, real estate appraising, personal property appraising, commercial real estate financing, check guarantee, collections, credit bureau services, asset management, acquiring debt in default, real estate settlement like closings, leasing of personal and real property, trust company functions, financial and investment, other kinds of transactional service for customers, and management and consulting relating to finances and banking. So it's all kind of money and banking related. And so that's fairly limiting. So if you're working for a bank or under a bank holding company and you want to do something new, you must always think, is this closely related to banking? Because you can't just engage in any activity you want to. And so if you remember, banks are companies, they want to make money. People like to do new activities to make more money. This is a real limitation. So the big change came in 1999 with the Gramm-Leach-Bliley Act. And we had the creation by law of a financial holding company, which is essentially a bank holding company that meets these certain requirements, which we'll discuss, and then makes the election. And it's basically, the requirements mean you're the best kind of bank holding company. You're very secure, very financially sound. And so this was a new type of holding company And just to give you a picture, it's just like before, except where the financial holding company is, where the bank holding company was, we have the financial holding company. It's just a different name. Have banks under that, affiliates, bank subsidiaries, they're called financial subsidiaries. But it is a new type, and it's all kind of on paper and by law. But to be this type, the bank must be well capitalized, well managed. The holding company must also be well capitalized, which is new. And then the bank holding company must file an election. And so any institution which is allowed to, because it meets these categories, will file the election, whether or not they intend to engage in the additional activities. So the additional activities are those financial in nature or incidental to such financial activities or complementary. So what we see is it's financial activities as opposed to only banking related. So still limited, but pretty significantly broader. And so since that was 1999, I guess that's now been 24 years, 25 years, I suppose. You may not remember, but prior to then, under the same holding company, you couldn't have an insurance company or a brokerage firm because those aren't part of the business of banking, but they are financial in nature. And so lending, of course, has always been permitted, but investing, insurance, both agents selling, underwriting, making the policies, underwriting them, financial advisory services that are more of a brokerage type, underwriting securities, selling and making annuities, mutual funds, merchant banking, which is a rather complex term, but is essentially a type of equity investment that doesn't include the management, just includes the ownership. And of course, any activities permissible for a bank holding company. So these are the items that can be conducted outside the bank, but in the financial holding company structure. And this is very significant and also helpful for companies that want to get into more activities. And really, it's very important for cross-selling. You have the client, you have them in your bank, and then you can sell them insurance, or you can sell them brokerage services, and it makes it easier to share information. You have a better picture of your customers. So it's extremely significant and beneficial to the companies. So just to give you a reminder here, the banks have the same powers, always incidental, necessary to carry on the business of banking. Under the bank holding company, all the other companies have to be engaged in activities closely related to banking. And in the financial holding company structure, it's activities that are financial in nature. And what we see is that 86% of assets of banks are in banks that are under a financial holding company. So all the largest banks are definitely electing to be financial holding companies. Now, as I mentioned, as we read about, they must meet these certain criteria. They must be well capitalized and well managed. They also have to have a community reinvestment rating of satisfactory or better. We'll talk about that in the weeks to come. And also the parent company must now be well capitalized. And we read about where PNC was a financial holding company and then they lost some of their ratings. And if that happens, it's very important because they only have 180 days to get back into compliance, or they become a bank holding company, which means they would have to get rid of all their activities that are only financial in nature, such as insurance and investments. So it's a great thing for a holding company to do, but it does mean they must keep these categories. And we will, in the modules to come, talk about what it means to be well capitalized, what it talks about to be well managed, and what CRA ratings are and how they are achieved. So as we finish up here, I did ask you to look at a couple of the questions, kind of one about how a company might pick where to put activities. And as you can imagine, in the bank, you will see there's really always more scrutiny. So oftentimes if something can be moved outside the bank into a non-bank affiliate, that can be beneficial. And you also were asked in one of the questions, why companies might pick this, even if they're not engaging in any of the activities that are allowed to financial holding companies are not bank holding companies. And it's really just to give them, as you can imagine, flexibility, and if they kind of think about new things that they would like to do. So we do see all the institutions permitted to be financial holding companies to make that election. So if you have questions about this, please let me know, and I will see you in the next module on privacy. Thank you.